Hey everyone, welcome to my market commentary for the second quarter of 2022. And the only thing that seems to be constant is the change in the markets we are seeing. We will be talking about the largest first half decline since 1970, quantitative tightening, latest yield curve shape, and a really interesting article that I just saw about the banks keeping deposit payouts low. Let's get into it. Hi, I'm Joe Macek, and contrary to many financial YouTubers out there, I am a licensed investment advisor and portfolio manager for IA Private Wealth, helping guide and counsel Canadian investors for well over 22 years. Welcome to my YouTube channel, Investing Made Simple, where you can find the most trusted information on building your net worth fast. Thank you for joining me today as we have a ton to talk about with the markets declining, quantitative tightening happening, interest rate hikes, and what that means for us going forward. But as always, before we get too deep into the video, I'd like to go through my usual disclaimer, and the long and the short of it is, before you make any decisions surrounding your money based on any video you see on YouTube, please take the time to consult with a fully licensed professional, or feel free to reach out to me on a one-on-one basis. My contact information is now provided in the description below. The other thing you need to do is absolutely decimate that like button for the YouTube algorithm. Yeah, just hover over it, as well as leave a super nice positive comment in the comments section below, as it really helps out my channel. And if you happen to like my content, I would be absolutely thrilled if you would just hit that subscribe button and darken that notification bell so you too can be notified when I upload such riveting content such as "This is the ultimate indicator of collapse" and "Dangerous market sayings you probably should not listen to." Did I say riveting? Yes, riveting. Okay, now back to our video. When we left off in our first quarter commentary, the Fed led us to believe that they were going to gradually raise rates, but changed their mind when they saw massive, now non-transitory inflation and decided to roll off the balance sheet quicker and delivered 3 of the largest rate hikes we have seen since the early 1990s. With the balance sheet roll-off starting to accelerate and these rate hikes hitting the markets, most major markets have seen their worst start to the first half of the year in over 50 years. And although these types of articles seem pretty bad, I would like to gently remind everyone that in 2021, it was an exceptional year for returns in the stock markets. With the exception of a few brief sell-offs, the S&P/TSX Composite Index produced a 25.1% total return. The S&P 500 gained 26.9% for the year. The Dow Jones Industrial Average gained 18.7%, while the NASDAQ Composite gained 21.4%. And so while yes, the opening for 2022 from January to June was the worst start in a really long time, you could see this as a bit of the froth coming off the markets in light of quantitative tightening and future hikes. As a result, a few months ago, I took the liberty to trim off some of the higher risk names in our major portfolios and purchase names that would serve to help preserve and grow capital despite negative market conditions. Something I will be going into greater detail as a supplement to my yield curve video just released. However, in July, we saw a pretty good rally in equities. Even after the Fed raised by 75 basis points, the third such huge hike in as many months, this suggests that the markets may think that the Fed tightening cycle could be over as quickly as it started. For me, I'm not so sure I'm in this camp. This feels like a good old-fashioned bear market rally, and the next little bit will hopefully strengthen my case as to why I'm thinking this way. First, inflation is still an issue, although there are some signs that the hikes and the balance sheet roll-off are having an effect on this inflation. But it looks like supply chain issues have persisted and will likely persist into 2023. I am still a firm believer that supply chain issues have had a pretty significant effect on the pricing of materials. With that said, the Fed has made it extremely clear that if they had to put the economy in recession in order to quash inflation, then that is exactly what they're going to do, and they're going to proceed with that risk. Second, the yield curve, and specifically the 10-year minus the 3-month, the one you should be watching, pretty much fell off a cliff in the last 3 months. And we are very close to having the inversion on the curve that has preceded all recessions since 1968. In fact, as of this writing, we are only 26 basis points away from inversion. June. For a more detailed explanation on how and why this indicator is so important, I would encourage you to watch This is the Ultimate Indicator of Collapse. Third, the savings rates of the consumers during the pandemic hasn't been as robust as previously reported. This, along with the savings rate being eaten up by inflationary costs, has started to harm the consumer and their purchasing power. We see some pretty good evidence of this in Walmart's latest earnings report, where the retail said their adjusted earnings per share will fall as much as 13% in the current fiscal year as US shoppers spurn big ticket items and focus on buying less profitable groceries. Current recession forecasts put the median probability of recession over the next 12 months at 47.5%, compared with 30% in June, according to a Bloomberg survey of economists completed last week. If we do go into recession, this will likely lead to lower earnings of companies over the next 12 months and likely lead to lower stock prices. And yes, this would be even lower prices than what we have seen currently to date. And my personal call is that if the Fed is to accomplish its primary job, which is to crush inflation, it will have the unfortunate consequences of putting us into recession. Okay, so I'm going to add a brand new segment here to my market commentaries, and this is so you can use this information to approach the markets given what I've forecasted in these commentaries. I'm also going to highlight one article that I found which is super interesting. It's a bit of an anomaly and could prove another thorn in the Fed's side. So in this article, it talks about how the banks in the United States are not feeling too compelled to pay savers on their short-term deposits at the banks. The article goes on to say that the gap between what banks are paying depositors and what they earn from lending money to borrowers hasn't been so wide in the past half century, with the average savings account paying a skimpy 0.06%. Many banks are telling shareholders that so-called deposit betas, measuring how quickly deposit rates rise in the wake of Fed hikes, will remain advantageous for the banks in the coming months ahead, as they're not yet feeling too much pressure to pay savers more. This is a pretty big deal. This means that the Fed is raising rates and the banks are charging more on their long-term loans as a result, but they haven't had to increase the interest expense on the short side yet. What does this mean in simple terms? Well, it means that the banks aren't in step with the Fed on the short end, only on the long end, at least for now, which is making lending extremely profitable for the banks. And with more profit comes, you guessed it, the more incentive to lend more and more money to consumers. This was confirmed in the article by CEO Brian Moynihan, who told analysts on July 18th, "We grew loans at the fastest quarterly pace in nearly 3 years." We will have to see if this eventually fixes itself. However, we could see a period where loans are expensive to get because of interest rates going higher, but banks are growing their loan book as hard as they can because they know it's that profitable. So with all this information, what do you as an investor do? Well, if you are younger and you have many years to retirement, this is an exciting time for you, as it's likely you don't have a lot in the way of invested capital, and it's likely that you will see a lot of red days and sales in the markets over the next year or two. Take advantage of this time. Focus more on the buying opportunity and less on your short-term performance, as it likely won't look very good for a while. You are probably going to see a lot of great deals on a lot of great companies. Consistently buy on red days and dips, even though there may be a lot of dips. It may also be difficult to see fresh money go into the market time and time and time again and have it go lower and lower and lower. But in the long term, you will probably be very happy you added as much money during a bear market as you did. If you are close to retirement or in the early stages of retirement, this could be a tougher time to get through emotionally. You likely have a sizable amount invested, and you might want to prioritize preserving capital at this time if you haven't already. Assess your portfolio, and if there are any names that are of higher volatility or higher risk, you might want to look at reducing those positions into these strong rallies and purchasing alternatives that have a strong track record during tougher times. Well, that's it for this quarter, and once again, I want to thank you for joining me here today at Investing Made Simple. Please hit that like button for the YouTube algorithm. Leave a positive comment in the comment section below, as it really helps out my channel. And if you like my content and you want to be kept in the loop with all of my latest videos, I'd be thrilled if you would just hit that subscribe button and darken that notification bell. Until next time, this is Joe Macek for Investing Made Simple. See you soon.